What's up, everyone? Welcome back to my channel. My name is Jabari Elliott, and this is Financial Finesse. In this video, we're going to discuss the different types of stock orders. And concepts from my earlier video, Stock Investing 101, will be applied throughout. So if you need a refresher on the fundamental concepts surrounding stocks, please watch that video as a prerequisite to this one. And with that, let's get started. A good investor takes advantage of different order techniques to both maximize profits and reduce loss. Making good stock picks isn't just about buying or selling well-researched stocks. Different stock order types allow you to maintain greater control over your investments by effectively timing purchases and sales. Stock order types typically fall into one of three categories: time-related orders, condition-related orders, or advanced orders. In this video, we will focus on the first two, as they can be executed in most account types and are suitable for new investors. Time-related orders are exactly what they sound like: orders with an established time limit. Now, these are typically used in combination with condition-related orders, which we will describe next. The two most common time-related orders are day orders and good till cancel orders, also referred to as GTC orders. Day orders are orders to buy or sell a stock that expire at the end of a particular trading day. If you place a day order for a stock at a particular price and the stock never hits that price, at the end of the day, your order will expire and your trade will never execute. These orders are rarely used when you want a stock long term and come with the realization that you may not get that stock that day. Now, GTC orders are the most commonly requested order types and the one I suggest. This type of order stays in effect until it is either canceled by the investor or executed. Theoretically, GTC orders can run indefinitely, but most brokers have a limit from 30 to 60 days. And although GTC orders themselves are time related, they are always tied to a condition. For example, you want to add a company stock to your portfolio, but it is currently priced above what you are willing to pay for it. You can make a GTC trade request for a price below where that stock is currently trading, aka a conditional price. Typically, GTC orders are useful in one of two situations. One, when you want to buy a stock at a particular price, but you do not know when your target price will be reached. And two, when you own a stock and want to sell if that price falls below a predetermined level. That brings us to condition-related orders. As you might have gathered, a condition-related order is an order that's only executed when a certain condition or price is met. When stock markets become uncertain, condition-related orders can be very useful, so we will cover the three most commonly used. A market order is an order to buy or sell a stock at the market's current best available price. Current best available price is referenced because stock prices are constantly moving, and catching the desired price can be limited by the broker's ability to process the purchase. These differences are usually small, but can play a larger role in volatile stocks with higher prices. The advantage of market orders is that they are processed immediately, and there's no worry whether or not a specific price target is reached. The disadvantage is that you can't control the exact price at which you purchase or sell a stock. Lastly, market orders get finalized in chronological order. So if orders ahead of you cause the price to rise or fall, your price may change. Limit orders are very precise condition-related orders. Limit orders are used when you want to buy stock at a specified price. For example, if you place a limit order to buy a $20 stock when it hits $16, that order will only be executed at $16, not $16.01, not $15.99. This means a limit order on a volatile stock may or may not get filled. Similarly, a limit buy order set above the current market value, let's say $22, is only executed if that exact price is hit as the stock price rises. Using a limit order to sell stock can secure profits, but also runs the same risk. If you buy a stock at $15 and the value of that stock grows to $20, setting up a limit order to sell at $19 could secure whatever profits you've made. However, if that exact price of $19 isn't hit, the trade will never be executed. While limit orders work well to buy stocks, limit orders to sell stocks carry a greater financial risk. If you're looking to protect your investment after buying a stock, which you should, stop loss orders work best. A stop loss order is a condition-related order that instructs your broker to sell a stock when that stock reaches a certain price or better. The set price acts as a trigger, which converts your stop loss order to a market order immediately. This order type should not be used for small, short-term moves, but to protect the bulk of your investment should the market move against you. For example, if you own shares of a stock at $30 and you set a stop loss trigger at $25, that order will be executed once the price falls past 25. Now, because technically this order is transformed into a market order, if the price falls past 25, the finalized order will execute at that lower value, not exactly $25. Most investors set up stop loss orders at 10% below the current market value for that stock. But one should always consider how volatile a stock may be when placing a trade. The main benefit of a stop loss order is that it will prevent a major loss in the stock that you own. Additionally, a stop loss order can be continuously edited as the stock price increases, allowing you to protect more of your earnings on your original investment. These are referred to as trailing stops and are discussed further in my video on income investing. Well, that brings us to the end of the video. Please like, comment, subscribe, and be on the lookout for future videos. And as always, keep finessing.